our next topic actually was, did you know, you need to use TradFi techniques to analyze DeFi risks. It's called math. And we were just going to talk a little bit about the current market situation, what has happened, and Reggie was going to educate us. And I would, if you could stay and join us in this conversation, that would be great. But Reggie, that's the topic that we need to talk about for the next 21 minutes.
Okay, 21 minutes.
And
okay.
I'm not that well versed in this sector, so you're actually educating me and the rest of the panel.
Actually, the whole purpose of the topic, maybe it's too many trendy words, acronyms, but I think you're very well versed in the topic. The point I was trying to get across is that oftentimes we come across a new technology, a new business model, a new industry, and the proponents of these industries or sectors or business models or technologies say, this time is different. It almost never is. You know, maybe the Ice Age or that meteor that hit and took out the mammoths, but the mastodons. But outside of that, you know, history either repeats itself or rhymes very closely. So a lot of the blowups that have happened over the last few months, Celsius and Voyager and BlockFi and FTX, apparently seem to have taken a lot of people by surprise. But if you did old school fundamental analysis and understood business models, you would have seen these things coming. Celsius first, and also as a disclaimer, you have to understand the technology itself. Okay, the technology, crypto, distributed ledgers, etc. You call the ledger distributed because it's distributed. The goal, at least from my perspective of going into crypto, is self-sovereign finance, the ability to hold your own assets autonomously, and when possible, minimize or eliminate counterparty and credit risk. That's the whole point. Okay, without that, there's no reason to do this. You can simply go the traditional centralized methods. You can use blockchain technology to maybe decrease some settlement times. But when you do that, you're still relying on the DeFi widgets. But if you're going to transact with other parties, decentralized credit risk, counterparty risk minimum techniques are the nirvana. You should always aim to it. So if someone came in here and his name was Peter, and he says, I have a cup, but I'm going to put a lid on this cup. But inside this cup with a lid on it is the world's most fantastic money-making mechanism. I need for you to put 100 Bitcoin in here, or $10 million worth of anything, $10 million of cash. You say, okay, Peter, I will do that. So you do it, you put it in, the cup blows up, your money disappears. Should you blame Peter or should you blame yourself? Okay, total black box, you don't know how it works. Now, the way Peter took ownership, possession, and custody of your assets, put it in a black box. The way I believe crypto transactions should work is you maintain custody, possession, and ownership of your assets at all time until you voluntarily give them up. If you give them up, it should go to a contract where the code is available for everybody to read and review. Everybody preaches that it's just a nirvana. It is not. Almost nobody reviews the code. But you have the opportunity to, and you can see a trail through the blockchain. When you do that, you replace Peter and his black box with a smart contract that's open on the blockchain, which does not take any undue credit risk, doesn't invest in commercial paper that's rated C, C1, B2, B3, et cetera. You're able to see everything. That's decentralized finance, a distributed finance. That is what I purported to have invented or created back in 2013. And the reason why I thought it was phenomenal, and I thought I was late to the party, was because these smart contracts, these smart contracts now replace counterparties, and these counterparty replacements also replace the credit risk. You know, computer code is computer code. if the computer code decides to go and lend out assets to BlockFi and Celsius, at least you're able to see it if you have the expertise to review it. And if you don't, you can always hide the expertise. But if you want to just give Peter custody and control of your assets in a black box or a gray cup with a lid on it, then you're basically, that is the antithesis of the entire platform and most of the discoveries in the platform, you know, and it makes no sense. It makes no sense from a purist distributed finance crypto perspective. It makes no sense from an old school traditional finance perspective. You know, traditional finance is, you know, your counterparty. Okay, you know the credit risk you're taking, or at least you try to know. You have an idea. If you take a look at some of them, and I'm going to make a lot of enemies right now, but you know, don't shoot the messenger. Okay, 2 + 2 = 4. You know, blame math, don't blame me. Okay, if you look at many of the blowups, like Coinbase. Coinbase is a public company. They report with filings, S1 filings, quarterly, etc. But Coinbase is a very, very risky entity. A, it's essentially a startup. B, it has very, very volatile cash flows. Basically, Coinbase makes money when Bitcoin goes up, and they lose money when Bitcoin goes down. Okay, Coinbase's bonds are inverted, where the shorter term yields are actually higher than the longer term yields, dictating risk from the market. They're yielding between 13 and 19%, and they've dropped in value about 45%. Okay, that's very risky. The market is telling you that entity is risky. Moody's, which rates Coinbase, rated them at Ba2 and Ba3, and now they're slated for a negative downgrade, for a negative review to the downside. So best case scenario, they'd be B1. Best case, most likely lower than that. So private entities, who are usually always behind the curve, most rating agencies tell you the house is burning down after it's level and the ashes are going up. Okay, so you have a late to the party indicator. You have the credit market, which is probably one of the most reliable. And then you move to the equity market. Since IPO, Coinbase has lost roughly 89% of the shareholder value, almost all of it. So the three major indicators are flashing red. But you have very large entities who should know better. They put a lot of capital in Coinbase and leave it there, as if Coinbase is a regulated bank with liquidity minimums and solvency reporting. They do not. You know, they're a shadow bank at best, unregulated. I'm not knocking Coinbase because every single cryptocurrency exchange is the same. And I say in air quotes because these are not really exchanges. Coinbase and Kraken and Binance, et cetera, they're actually broker dealers. Okay, they're broker dealers that trade principal as agents, et cetera. They're not exchanges. A true exchange does not use its own capital to trade with, for, or against their customers. But that's a nuanced definition, but that's also a very important definition because the amount of counterparty and credit risk that you take doing business with Coinbase, it is contradictory to a lot of the assets that you would put into Coinbase. Perfect example would be stablecoins. The fear of stablecoins that I've seen in the media is that the reserves are not AAA, they're not high quality, they're not all there. Let's suppose they are. Suppose every stablecoin issuer, not algorithmic, but every backed stablecoin issuer has no more than 20% cash, no less than 20% cash and no less than 80% short-term treasuries, 3 months or less, short duration, et cetera, et cetera. I'm not sure that's a fact, but let's assume that is a fact. The reason why I use a stable coin is you want it to be stable relative to the US dollar. You want it to be safe. You want it to be liquid. So you want a AAA rating. You want the equivalent of cash. Number one, stable coins are not that. Stable coins are return-free risk because with cash, you can generate a return. With a stable coin, you can't because the stable coin business model is predicated upon you giving the stablecoin vendor money, $100 million, and then they invest that $100 million and they keep the yield, the spread in return. And you get nothing except for the actual token, which moves through the blockchain. You're taking the risk of dealing with a stablecoin operator. And all the stablecoin operators are startups. So startup risk is high to begin with. And then you're taking the risk of a startup in the crypto industry, you're tripling that risk. So you're taking their operating risk, their credit risk, their counterparty risk, and you're taking the investment risk when they go and invest. 3 layers of risk. How much you're getting paid for that? 0. Return-free risk, which is a word play on the risk-free return, which also I think is nonsense. I don't believe you can get return without risk, but that's a story for another day. Return-free risk should be an impossible sell, but stablecoins, Tether has at least 80 billion, USDC probably has 56 billion, etc. So let's assume getting return-free risk is not a bad thing, which it is. Let's assume that dealing with these startups as actual banks is not a bad thing, which it is. And let's assume they have all pristine investment, all bankruptcy remote, and individualized, compartmentalized accounts that can't be touched by a patent holder, which sues for infringement, to say, which they're not. But assuming all these, which I don't know if they're not, let's put it that way. Let's assume all those things are 100% legit and kosher. Once you take a AAA asset and you give it to a broker-dealer / exchange that has a deeply junk rating that's lost almost 90% of shareholder value, and that's being downgraded by the private rating agency, and whose bonds are yielding between 15, 13, and 19% inverted, right? And whose bonds have also lost 45% of their value, you have taken that hopefully wannabe AAA risk, and you made it instant junk just by giving it to them.
So there's a lot there to unpack, and I just want to reset some of the thoughts that I have here. And I'm asking the folks on the audience or in the panel, if you do have questions, help me out here, because if I look at what has come to bear, if we look at Coinbase, the depreciation in the value after it went public, the meltdown of FTX and the domino effect and all of those other companies associated, invested, or in the same sort of category. Let's assume, just for argument's sake, that the public markets did not head in the direction that it headed in at the beginning of this year.
Mm-hmm.
And the valuation of public equities did not collapse as it did.
Mm-hmm.
Let's also assume for a second, and I don't know this, and maybe you have an answer, there's a blow up on FTX and all the associated companies, anything that's involved in that industry. All of a sudden, everything you are saying now starts to make a lot of sense, because we're in conflict of the investments we made or thought we were making and the monies that we were getting returns on our staking business. Let's assume that the market was not in the condition. It was still the exuberance that we saw in 2020, 2021.
Mm-hmm.
What then would have happened, or what would have happened to Coinbase, FTX, and the associated companies in this space?
Well, eventually they would have imploded. And I want to give a couple of perspectives. One of the previous guests said that there was a high correlation between crypto and equity markets. That's not really true. It's true now, but it hasn't been. Bitcoin, and to a lesser extent Ethereum, had a very, very little correlation, close to a negative correlation to the S&P 500 for quite some time. I got in 2013. I'd say from 2013 to about 2017-ish, 18-ish at least. Very low, almost negative, very, very low correlation.
Yeah.
The reason why I feel that correlation closed and became very, very close to 1 is because the traders who traded equity financial products got into crypto. And then that made the correlation close and approach 1. Crypto has nothing to do with the equity market. There is no fundamental reason for them to be correlated. But there is a quantitative reason for it to be correlated, because when the buyers start to move in the same direction, it's the same pool of money, well, then you'll see the correlation. Now, as for what would have happened if the equity market, hold for 1 second. Can you hear my dog scratching on the door?
Yeah.
Okay, well, try and ignore him. The reason why the reason why FTX failed was because the investors and users in the FTX just didn't do fundamental analysis. They didn't do due diligence. FTX's balance sheet held FTT tokens, which were their discount tokens, and they printed these, and an arbitrary value was given to them. FTX is an exchange or a broker dealer, and they were the largest broker of their own tokens, which they created. All you have to do is value the tokens, and they're not hard to value. They discount trading on FTX, okay? You take a look at FTX's annualized trading or annual trading revenues, okay, over a period of time. You project them out using the same growth rate that you've seen, and you discount them back to the present, and then that's what those trading revenues are worth. You take the discount that the FTT tokens, apply, right? And now you do this. Now you have the value of the FTT tokens. Since FTX is private, not audited, and you can't really trust what you see or what you get from them, you put a heavy discount on that. So instead of being billions and billions of dollars of assets on the balance sheet, it should have been tens of millions. Yeah. And if you see any activity above that, then there's a problem.
So that was interesting because that question came up not only in my mind, but several other people's mind. The correlation was strange that the crypto market was correlating with the public markets. And so you've helped explain that a little bit. But let's do a prognosis, given your experience and background. If we look at the valuation today of the public equity market, are we still expecting a further correction given all the environmental fundamentals?
I mean, I've stopped doing the public market a while ago. Valuation earnings in general have not increased as much as valuations, which meant that, it has not increased as much as prices, which meant that valuations were expanding. I could not see a fundamental reason for valuations to expand. The printing and the QE cause prices to go up. They cause valuations to expand. That's understandable and it's visible. That doesn't make a strong investment thesis for me, but that's not the way I invest. I invest on fundamentals and macro. If you're a trader, a quant guy, that's your game, and you're probably better than I am. That's not the way I do it. So your question is really germane to the risk profile and investment style of whoever it is you're talking to. From my perspective, the U.S. equity markets, I'm going to stick to the U.S. The U.S. equity markets, I think, have been overly optimistic for a while. They have corrected, but if you take a look at it from a longer perspective, they got carried away. They basically responded to large amounts of liquidity in the market. That liquidity, as it gets soaked up, is going to be a problem unless earnings spike up accordingly. And I think many of the technology sectors may be able to have a story that justifies it, but we haven't seen it. If you look at Facebook and et cetera, heavy investment, and I don't necessarily fault the investment, but I don't know enough about it. But heavy investment is for future returns. For right now, I just don't see the argument. And then the traditional retail and other sectors, again, I think they've just gotten away from themselves and they haven't caught up yet. But I'm a realist, and a realist is considered a bear, a perma bear. So
hope, I think, forestalls the anticipation of despair. So let's talk. But here's a question from Edward Brooks, and it relates directly to the topic, and I'll read it out to you. Since we know that big banks, BlackRock, politics, WEF, I assume that's the World Economic Forum, etc., run or want to run the world, how can DeFi be the future of finance with the global system functioning as it is? Don't we need a massive watershed moment, reset for DeFi to be majorly adopted?
Well, DeFi as an operating concept in and of itself, I don't think we'll ever run the world, because those entities that the money center banks and the large financial entities, the fire sector, finance, insurance, real estate, their entire business model is predicated upon rent seeking. So they need a centralized model, okay? And the only way for them to benefit from a decentralized model is if they can stand as a gatekeeper between the participants in the DeFi model. If they stand as a gatekeeper and they're able to collect rents, then it's no longer DeFi, it's back to centralized. So I think very wonderful concept. That's what I was thinking when I patented a lot of the widgets that I created. But in reality, I don't think it's going to work at all. But they are adopting distributed ledger technologies because it is a less expensive, more efficient way of transferring capital in an audited fashion. When they adopt these, they're going to adopt it in centralized models, but they're going to using decentralized financial widgets. And those decentralized financial widgets are going to be used very, very heavily. So you're going to have the DeFi machine, but it's going to be used by the centralized operator.
So interesting. Actually, I'm just going to recognize Nigel, Nick, Bharti, and Ryan, who are on the next panel. And the conversation of the next panel will be institutional adoption of DLT, trends and regulation. So if you want to stay a moment, we'll ask the other panel to come in so that they may have a couple of questions on exactly what we're talking about. And I notice I've been here for a while. So Nigel and Nick and Bharti and Ryan, if you want to join us and ask Reggie an important question or any question, because my next lead up to the question was, I know, Reggie, you've scheduled till 5:30. Do you have a few more minutes to stay?
Yes.
Perfect. So my next question would have been to you. We see there was a huge transition. Crypto was sort of on the sidelines. The technology was on the sidelines. And then over the last 2 to 2.5 years, we've seen Fidelity, BlackRock, all these large institutional players starting to adapt into this environment. Now, they took a long time to get there before the meltdown that's happened over the last year with various environments. Do we think that they're late to the game, or will, because of their entry to the game, what do you think will change in the environmental capital structures that are involved?
Well, I don't agree with the premise that they're late to the game. They were coming in roughly about the time that I got in 2013, some of them 2014 and 15, but just a couple of, fun facts. Mr. Moynihan, the CEO of Bank of America, boasts of having between 200, 300, and 500 patents issued, or 200 or 300 patents. And they have many patent applications. Now, I went through a lot of them, and those are patents concerning the minutiae, the dust and the fine hairs around their particular business models. They're not foundational technology patents, such as the ones that we pursued. But regardless, these patents were from 2014, 2015, 2016, not necessarily to the party. JP Morgan, another big player in the space, owns significant portions of Consensus, hence Infura, the Infura server system, MetaMask. Again, not late to the party at all. That's critical infrastructure in DeFi, since Ethereum is about at least 70% of crypto activity. Many of the money center banks add up to roughly, or the fire sector, which is mostly money center banks, then Fidelities, et cetera, make up roughly about 2/3 of the investment book of, the cap table of Digital Currency Group. Digital Currency Group is the largest private investor in the space. CoinDesk, Kraken, Coinbase, et cetera. So again, not late to the party. Banks have been in existence for about 5,000 years. I doubt if they're going to go anywhere over the next 10 years as crypto or DLT expand. They saw the writing on the wall, and they're the gatekeepers of money or capital. And so when capital is a solution, banks are very rarely going to be the losers. So they deployed capital and they got ownership. I think they missed the ball on the patent side because, again, it's a long discussion, but I think they made everyone miss the ball. But regardless, they've deployed capital. Now, as they take over, I feel that this is jurisdiction specific. Regulators in the US are clearing the land, clearing the space for banks to move in on an operating basis. Most of the entities that could have or would have challenged the banks have faced very, very strict or very, very stiff issues from regulators in the US. I'm not going to name the regulator, but a couple of Google searches can give you many examples.